Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenivek from Bloomberg Radio.
Today, traders, it's not just about Nvidia, folks. They waded through some mixed economic data that showed U.S. industrial production increasing in the month of May, helped by a broad-based pickup in factory output. And then separately, that retail sales report this morning barely rose and prior months were revised lower. So that, Tim, suggested kind of greater financial strain among U.S. consumers.
Okay, with more on this morning's sluggish U.S. retail sales report and a move lower in U.S. yields. With us, Bloomberg News economics editor Molly Smith. Also, Bloomberg News rates reporter Michael Mackenzie. They're both here in our studio this afternoon. Molly, I want to start with you, and I want to start with the data because here's the headline numbers. Retail purchases, unadjusted for inflation, increased 0.1% after a downwardly revised 0.2% drop in the prior month, according to the Commerce Department. Excluding gasoline, sales rose 0.3%. Dig into the report for us, though. What exactly do we need to know about these numbers beyond the headline numbers?
So the retail sales data really just captures what we spend on goods. So think of that as like physical stuff, like furniture, clothing. Gasoline is actually a really big part of this, and gas prices were cheaper in the month. So that actually dragged the number lower because remember, this isn't inflation adjusted. So if you see a category decline, that could also just be a reflection of lower prices, not necessarily lower spending. Exactly, less demand and spending activity. So, but taken all together, this really did point to a definite slowdown in demand, especially when taken with the downward revisions to prior months, as you mentioned, Tim, and really just as we saw, a few economists actually lowered their tracking estimates of GDP for the quarter coming out of this because there is a measure within the retail sales report that feeds into GDP and how we impute consumer spending from that.
Michael Mackenzie, come on in on all of this in terms of we did see some reaction, right, though, after that U.S. retail sales report.
Yes, you did. You saw the market rally again. We got down close to last week's lows. Then we kind of sort of stabilized for a bit, still holding a good rally. And then we had the 20-year auction. And I think what you're seeing with the bond market today is we got back to pricing in just under 50 basis points of cuts for this year. That kind of is a limit for the 2-year, for how further its yield can drop. What you're really starting to see here, and what I'm hearing from investors I've been speaking to the last few days, is people now beginning to think they've got to get into duration. They've got to extend out the curve because they're looking at the retail sales data and they're thinking, is this another little sign that the consumer is under stress, or at least beginning to get worried about this, the employment market? So therefore, it's pulling back on spending. And talking to investors today, they said it's not really retail sales that's driving this. It's more the idea that maybe the retail data is telling us the consumer is getting worried, and therefore we are getting close to that moment when the employment market starts to crack a little bit wider. And then, as we know from what the Fed officials have been saying, there's been a lot of them talking today, they are still sticking to this line. We're going to be patient, expect a cut, maybe two. That's kind of the story, right? That's what the market's priced in. But if the employment market starts to deteriorate, then, as someone said to me today, an investor said, you've got to be thinking about the next 6 months, the 2025 trade. And it's going to fall either way. Either within 6 months we'll know labor's okay, it's got through this period, or it's actually starting to fall apart. And that's how you want to be positioned. So what we're seeing in the bond market in the last few days, and spill over from last week, because both the 10-year and the 30-year auctions were very well received. Today, the 20-year is well received. So you've kind of got this group of investors out there saying, I'm going to buy here because there's a risk here that maybe the economy is weaker than we think.
Well, Michael, what I'm hearing from you is different than what we've heard from you over the past few months when we've spoken to you, over the past few weeks even. And I'm wondering what it was that you think that prompted this sort of shift in tone or shift in outlook from the investors you speak to. What was the piece of data?
It's more just a combination of data, and it's more the anecdotal at this point.
Okay.
I think, and the fact
just
that
in our newsroom, can I just share anecdotally? It's not a Fed survey. It's nothing official. No government entity endorsing it.
Can we put it in the beige book?
But we could probably put it in the beige book. Well done.
All right.
For the New York area, that would
be. Exactly. And specifically the Bloomberg newsroom area. But people talking about prices of things and making choices about things. And so I feel like we're just hearing consumers saying, I can't be all in on things. I am going to have to make some choices.
You can see in the restaurant business,
tone,
right? The restaurant business is starting to hurt. Certain areas really feeling the pain. And I think some of the airline stuff is interesting now. Less demand than they expected for flights. I think you're hearing more talk about how all these accumulated savings that were built up after COVID or during COVID are now running down. And I think people are battening down. They're feeling more cautious here. Now, again, against that, you've got record stocks.
I know.
The housing prices are still very high. And don't forget, the American homeowner can tap a pretty hefty line of credit from their house if they need to. So I don't think you're going to get a real fall. But it is interesting listening to some people in the bond market now becoming more confident about moving into treasuries, out the curve, just thinking that maybe
this might be as good as it.
This is as good as you're going to get, but also the Fed may be falling behind the curve. They're hearing a bit more chatter of that now as well.
Molly, what are you thinking in terms of, we had a guest on, was it yesterday, last week? I don't know, the days all meld together. But just, that when the job market starts to come undone, it can move pretty quickly.
Well, this is where I have a hard time squaring all of this, because what we're talking about within our team is really like what is the best signal to take about the jobs market right now, because the last report was so conflicting and that the two surveys between payrolls and households have been moving so far apart. So you have in this one camp where the data seems to really trade on and where Fed officials seem to take the most signal from is the payroll survey, which has been really robust. That came in about 100,000 above estimates in the last month. That's hardly, to me, showing a sign of softening. Then you have the household survey that everyone seems to poo-poo and say, oh no, it's the smaller one, and it's about to get even smaller actually. There's a sample cut coming, and that's where you're getting the actual weakness in terms of that employment measure coming down and unemployment going up. But people are saying, oh no, don't, the household survey's noisy and, we don't take as much signal from that. So I think that's really difficult to say then if you're going to argue that the labor market is softening, which yes, job openings are coming down, some unemployment claims are going up, but the biggest signal is still saying that the jobs market is very strong.
Okay, so what changes your view? What's the signal that you're waiting for, Molly, to make it sort of match what we're seeing anecdotally, or what at least you're hearing anecdotally?
Well, I think that's another thing when you say about matching it anecdotally, because I think this is really where it depends on where you are in the country. I was listening to we had Cleveland, outgoing Fed president of the Cleveland Fed, Loretta Mester, in the other day, and she was saying to us the reason why she trusts the payroll survey is because when she talks to contacts in her district, like that beige book, that the payroll survey really seems to be more indicative of matching up with the anecdotes in that district. So I think that's really increasingly of where you are in the country, of how the anecdotes match up to what part of the data you're looking at.
I keep thinking too, though, I'm already looking forward to earnings, which are less than a month away. Where
the countdown has begun.
The countdown has become, where I hope, the C-suite is pushed about their labor needs. Are they hiring, to get an idea of what's going on? It's just a small swath, if you will, because it's a lot small and mid-sized businesses that really kind of make the backbone of the U.S. economy. Having said that, Michael, I keep thinking about this inverted yield curve and when does it eventually pay off, or do we again need to disregard it because we just went through a pandemic and crazy amounts of liquidity, and how much is distorted as a result?
I think the jury is still out, but my own personal view here is that it is distorted. It's a broken indicator. It's
interesting.
It indicated that this is a bond market that has been sticking pretty resolutely to the pivot trade and is doing it through the long end, so the 10-year. So this is why the 10-year remains stubbornly below both the funds rate and the 2-year yield. And if you go back in history, this is a pretty deep inversion.
Right.
So it suggests, on the one hand, I hate using the economist term, that the Fed is on hold.
Don't do it.
The Fed is on hold for a long time and maybe makes a couple of cuts, and that's about it, right? And then eventually yields kind of get very flat. And the other scenario, of course, is that the bond market is finally going to get right, like a stop clock. All these pivot trade sort of views come to fruition because employment does start to deteriorate. The Fed has to cut. But it's interesting too, because if you look at how the market looks at the Fed's terminal rate, it's there at 3.5 4%. They don't expect a really big cutting cycle. So the trade really now is, do you think the economy is going to weaken a lot? Because if you do, then you should own 10s and 5s, because the Fed will have to cut not just down to 3.5, but probably back down below 3. But that's your risk reward, and that's kind of what you're seeing in the bond market. You're seeing that debate taking place, and it's just interesting that it is tilting a little bit more towards a sort of a harder landing. If you look at the way that the sort of 5s, 10s are rallying here. And it could be, they've been wrong 8 times so far since late 21. Maybe they get it wrong again.
For those who are keeping track, like Michael Mackenzie.
Again, ultimately, one day they could be right, and therefore that's the trade at the moment, really.
All right, just to kind of wrap up. So our next focal point, is it another inflation print next week? Like, what is it for you?
Yeah,
Molly?
I mean, we've got PCE. Is that already next week?
Yeah, it's not so.
Oh my goodness! Wow, the time does fly around
I know, when you're having economic fun.
Yes, and I mean, as we saw from the CPI and PPI data last week, it looks like PCE is going to come in pretty soft. A 0.1 increase in the core month-over-month measure. I think that would be the least since November, and that's where most economists are tracking right now.
So the trend line is there?
It is there, I think, but it's, again, so interesting. When we had 3 months of horrible inflation news at the beginning of the year, you get one that's in line, and then last month was very good, and everyone's like, the downward trend has resumed. I think it's amazing how quickly that narrative shifted, and that we have now totally discounted the first quarter robustness.
That's a great point. I mean, for trend, I don't know. How do you think about
if you
that?
look at inflation break-evens in the Treasury market, they're at 2-year lows. So I was talking to an investor today who said they're actually buying that as a hedge, because they're not ruling out a resumption of sticky inflation this summer. So it's a cheap hedge. But as he also said to me, I'm also long 5s, because if it does turn out to be a weaker economy,
that's why we have 2 hands.
That's why we have 2 hands.
You guys are great. So appreciate this setup and analysis on this Tuesday. Bloomberg News economics editor Molly Smith and Bloomberg News rates reporter Michael Mackenzie. That's a look at the economic news.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Okay, we're keenly focused also on shares of Nvidia, man. They are outperforming in a big way, up about 3.8%, as we said, surpassing Microsoft to become the world's largest market cap company. So let's get a little bit of context on the stock that continues to just outperform on so many different metrics. Back with us is our chief markets correspondent, Abigail Doolittle, right here in our studio. It's the biggest.
It's also up 175% year to date. We're not even 6 months in. I mean, it's incredible, the run that this stock has had. And of course, it has everything to do with AI. But in a lot of ways, they do deserve a big move higher, just because the numbers they've beaten so handily. And in terms of the outlook, that continues to be brought higher and higher. So long as the music is going and doesn't stop, people are just, dancing. They're not looking for their seat. The minute that music stops, and at some point they're going to put up a quarter that's not like all these other quarters over the last 4 to 5 quarters, then there's going to be significant issues, I would say.
Why do you say that? Just because it's gone so high?
It is
so
absolutely
far.
parabolic. If you pull up a chart of this stock, it's
incredible.
Almost a 90-degree angle. Just from a physics standpoint, that cannot hold. There's one
That's
exception to that, to my memory. Now, Tesla, it had a parabolic uptrend in 2014 into 2015. That did hold, and then it broke into a range. So maybe Nvidia, it could, but more likely it does not. The other thing is, so you were just mentioning how I'm going to really try to talk to about this chart to our viewers and our listeners, because as you mentioned, Nvidia has taken over Microsoft and Apple just slightly. But Apple and Microsoft for years traded above the $2 trillion mark before making it above $3 trillion mark. Nvidia, as of last year, was at literally at this time last year was $500 billion. Yeah. I mean, it's just gone.
Wait,
yes,
half a trillion.
$500 billion.
It's now 3.3
It's now the world's most valuable
trillion.
company that quickly. So, I don't know if I'm smelling tulips. I don't think it's the tech bubble because there's something real here. I don't think that it's the housing bubble because it's not leverage. Although maybe you could make it the case that it's leverage because there's so much liquidity in the system. Those dollars have to change something. This is the best house on the block. People want in, again, until the music stops.
I mean, you look at the revenue growth year over year, you look at the earnings growth year over year. I mean, it's just, again, the charts are just kind of off the chart, the growth. And I guess you're right. Like, I'm thinking, all right, I just marked down August 23rd is their next earnings. Like, do we start to see a little bit of a slowdown in terms of some of those numbers, or at least their outlook? Like,
it is incredible, Carol, because I've just pulled up that FA function. And so for, yes, it's absolutely incredible. The year that just ended in January 2024, they're in a fiscal year, 126% revenue growth. That's $61 billion. These aren't small numbers. For the end of next year, another 100%, then 34%. But yes, as that starts to trickle down, and if it happens in a way where there's a surprise, like right now people are looking ahead to that, they'll deal with 2026 and 30% growth when we get there. But if that starts to trickle down for some macro reason or other reason ahead of time, that could be a real issue. It's also going to be an issue for the likes of Broadcom and AMD, anything related to AI.
Okay, well, I guess it is related to AI still because of the Apple event we saw last week. Apple Intelligence, so we can go ahead and call Apple an AI company now, perhaps. But I'm interested in, not in your thoughts about the company and AI, but your thoughts on
into the marketing slogan there?
The chart. I'm interested in her thoughts on the chart.
I know.
Because this is something we've talked about quite a bit over the last few weeks, Abigail.
Yes.
What are you seeing when you're charting Apple?
So this chart is really ridiculous. It just popped right out of a range. There were a lot of signals, including the momentum that suggested it would go back down into the range, the fundamentals, the single-digit growth, the valuation being somewhat stretched at that point. Now it's outrageously stretched. So Apple last week at one point up 14% in 2 days, the best 2 days at those highs since 2008. Since then, it's consolidated in a very tight range between about 215, well, right now 214, 213 something. Let's call it 210 to 220. Those buyers and sellers trying to figure out what's next. It's narrowing. I would say within a week to 2 weeks, we're going to have a big move out of this near-term area of congestion. Again, the signals suggest, and it's hitting another longer-term level of resistance, the signals suggest that it should be to the downside. The single-digit growth, the valuation right now is very, very stretched relative to Apple, relative to the peers. It's trading, I think, 30 or 40% above the valuation of the peers. But I will say there's a rumor, well, actually I shouldn't say that. There is a theory, there's a narrative floating right now, which is, yes, their AI is okay, but the iPhone, that people want to buy for that.
All right.
Good stuff. Again, Nvidia right now up about 3.6%.
All right. That's Abigail Doolittle, Bloomberg Chief Markets Correspondent.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A little bit of a setup here. U.S. fund managers suffering their worst ever quarter for ESG-focused products as the price and actually the pace of client redemptions intensified. Client withdrawals from U.S. funds targeting ESG, environmental, social, and governance goals, reaching $8.8 billion in the first 3 months of 2024. Tim, this is all according to fresh data from Morningstar.
Okay, the bottom line here is that for 11 of the past 12 quarters, clients have redeemed cash from actively managed funds, registering as, quote, promoting ESG goals. That's according to data from Morningstar.
Yeah, and it all really indicates kind of a recalibration underway in an investing forum that from the get-go is supposed to favor the active selection and deselection of assets. So let's see what our next guest has to say about it, because he's doing his own recalibration. Joining us now is Jason Britton. He's the founder and chief investment officer at the registered investment advisor Reflection Asset Management. They've got about $5.9 billion in assets under management. And Jason joining us right here in our studio. Welcome, welcome. You believe in ESG, but you are doing a rebrand. Why?
So I believe in the concept of what ESG is supposed to be. My challenge has been in its execution. So we're actually rebranding it to actually reflect what an investor is supposed to look at. ESG data historically has been from a business management decision tool perspective. Where are companies experiencing materiality risks to their business model? Nothing to do with how you'd select a security or why it should be in an investor's portfolio. So I'm actually pleased to see those outflows because I hope they're going to smarter places.
Does it need a label, though, or does the market take care of ESG on its own? So, does money go toward the places where decarbonization is happening without us calling it ESG?
So I think it does. I was just having a conversation with one of my colleagues, and the companies that are doing the quote unquote right thing, thinking about their environmental footprint, thinking about, bringing down supply chain miles and managing inputs, throughputs, and outputs, that's just good business, right? Classically trained economists, you want to do more with less. I do think it does need a moniker switch, and I do think it does need marketing because it's such a passion for young people. I mean, something like 76% of women, regardless of gender, and 80+% of millennials and Gen Z align their personal preferences with it on the spending side and want to see their assets managed that way.
Well, and maybe it got lost in impact investing. To me makes more sense. Like, is it having an impact badly or negatively? But we could get into a big debate. You have your own acronym, C. Talk us through it.
So C for us is stakeholder, environment, and ethos. So what we're looking at is we want to understand how a company is being managed and is it thoughtful to its various stakeholders. We're talking about its employees, we're talking about shareholders, we're talking about customers. When we look at its E for the environment, that's traditional, that's the same. You're looking at managing your footprint, you're looking at being in industries that are heavily polluting, where you want to be thoughtful around limited resources. And then finally, the ethos, we call that the culture fit, right? Culture is a huge issue. It's number one driver in terms of, if you look at all the kids who are coming out of the top 10 business schools, they're really concerned about the perception and how that organization is viewed out in the world. And for us, that's essentially assigning a corporation a personality, right? Physician's desk reference. Is it a homicidal maniac or a friend you'd bring over for dinner?
Okay, let's talk individual companies here. Mm-hmm. Just top of mind for me is a company like Tesla, for example, because from the perspective of environment, I think many people would argue, wow, it's doing the right thing. It's getting a lot of people to think about EVs. It certainly moved the needle when it came to global EVs. But from a governance perspective, or maybe you would say from a stakeholder's perspective, not everyone agrees with the way that Elon Musk runs the company and the recently approved, once again, pay package that is just massive, $56 billion. How do you see Tesla fitting into your framework?
So in my particular framework, Tesla does a whole lot better than some of the other challenges and things that have been reported recently. I mean, when you have, and I think it's MSCI, but don't hold me to it, it might be S&P, have put out a report where ExxonMobil and Philip Morris both score better than Tesla on a lot of these criteria, and that's just nonsensical. I mean, I guess there are reasons for it if you're looking at it depending on how you're weighting the S versus the E versus the G, and that's my other problem, back to your question. It's a black box. They don't tell you how those ratings and those methodologies work. Ours is straightforward. It's peer-to-peer by sector, force ranked by quartile. I mean, even the most average retail investor can understand you're the first quartile, you're the second quartile, or you're the bottom half. The rest of it is just sort of industry averages and lots of smoke and mirrors in marketing. I do think that there are some challenges as it relates to the labor issues around Tesla. There are challenges around outsized pay. Not that I necessarily think that when you have a stock incentive and you hit those targets, that was the board's decision, and that is, in fact, good governance.
But what about a CEO who says some very controversial things?
Or maybe CEO of several different companies and not have full attention on that one company.
Right, like how would you, in terms of culture fit?
Well, so those are two things there, right? So culture is how he's managing the company. Whether or not he's behaving appropriately and saying some pretty outlandish and ridiculous things through his X account are different issues. Thank goodness, being an idiot and having a very loud and very controversial opinion is not yet something that we've figured out how to put into financial models.
Okay, but should we?
I mean, I've always been a proponent of trying to be able to figure out how do you charge back for pollution? How do you really put the dollars and cents where they belong? That's the math.
Well, it's funny because, we have these conversations, Jason, that it's like, here's a company that's doing something really well, protecting the environment, doing the right thing, but maybe their financials aren't so good. Do you put that in your portfolio?
So I don't. Right? Some other folks would. So when I want to be clear, when we talk about the C methodology and the technology business that we built, which is Reflect Values, which helps financial advisors do what we do, but with their clients on their desktop, we're focused on the traditional fundamentals. It's got to be a good stock anyway. And then we're using these additional C criteria to separate the wheat from the chaff. It's not instead of. You can't just be an ESG company. They call that philanthropy, like it's the Red Cross. If you just want things that are well-intentioned and doing great things in the world, write a check to that. If you're looking to have your investments managed in a way and look at data that's different than what other people might be looking at, C's your methodology.
There's one name that we're dying to ask you about.
Nvidia. Carol and I were talking about it earlier. Look, it's a company that is the most valuable company in the world right now.
Today, for the moment.
For the moment.
What was the last tick?
There are some questions about ESG, or I don't want to call it ESG, SEE, right, Carol?
Like, Jason, you like this name, and you would put this in, it is in your portfolio.
It is in the portfolio, yes.
Do you think about the impact that the people are buying all these chips to run these data centers that are going to use up a lot of energy? There's a lot of controversy over that. You could also go into, we don't know exactly AI and its next iterations, current iterations, the impact it's going to have on deep fakes, misinformation, the impact negatively it could have on society. So how do you cross that with your metrics?
So there are three issues at play there. One is when you're looking at energy use and energy consumption, I'm looking at not just the AI names that sort of have already run up the big five.
Yeah.
What's interesting to me is the second and third derivative. So it's those companies that are building these data centers that are more efficient, more energy efficient, and also more efficient from a footprint perspective, right? There's no reason that they need to be these million square feet behemoths that are pulling all this different power. There are lots of other ways to think about that. Look at companies like Caterpillar and other places where they're building these more efficient power distribution and power storage. I would also take to the second part of that, which is when you're looking at the ethics side of the AI business, consumer privacy and what happened with Jennifer Lawrence and some of the issues that around, OpenAI, those are real issues. I don't necessarily think they're AI specific issues.
Do you mean Scarlett Johansson?
Yeah, I beg your pardon, yes.
Which they've denied, we should note.
Correct.
Yeah.
They have denied.
Sam Altman has denied that.
Yes.
But to be continued. So Nvidia, yes, no in your portfolio?
So yes,
Just
it is in the
quickly.
portfolio, but I would actually start to trim the position. I think it's fairly valued.
But you're trimming it because of that.
I'm trimming it because it's that.
Because of the run-up. Really interesting conversation. I feel like taps into a lot of what we're trying to figure out when it comes to whatever you call it, right? In terms of these interesting metrics about the impact or harm that different companies could do. Jason, thank you so much. Jason Britton, founder and chief investment officer at Reflection Asset Management.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Boeing CEO Dave Calhoun faced searing criticism in a Senate hearing that accused him of failing to overcome the company's manufacturing shortcomings by putting profit ahead of safety. Here's what Senator Richard Blumenthal, a Democrat from Connecticut, said in his opening comments, quote, "You and your board of directors have a duty to your shareholders, but they will be deeply ill-served if you fail to correct course and confront the root cause of this broken safety culture." For Boeing, it's a moment of reckoning.
It's a moment of reckoning. Investors sending the stock, shares of Boeing lower, down about 2% as we speak. So for all things Boeing, we turn to George Ferguson once again. He's Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joining us from BI headquarters in Princeton, New Jersey. George, thanks for coming back. Obviously a difficult day for the Boeing CEO. Some would say rightfully so. But how are you thinking about what we're hearing from these hearings and what it really means for Boeing's future and maybe the CEO's future?
Yeah, so I think the stock, like you said, is a couple percent lower. So it's not like there's any, I think, big news coming out of this hearing. I think what it is a lot of frustration, right? There's a bunch of senators that want answers to questions that they're not going to get, and so I think that it's just not a good day from a publicity standpoint for Boeing. But there's been a lot of days like that lately. I think the turnaround is just going to take a bunch of time, right? And they've got this plan with the FAA for how they're going to turn around manufacturing, improve quality, and unfortunately, something like that, just like I said, you've got to implement it, and then you've got to watch it over months, quarters, years, and look to see for progress. And senators want to turn around today, and CEOs want to turn around today, but it's almost unmeasurable at this point. So to me, again, I think it's sort of a negative publicity day and just a frustration day. Does the CEO deserve it?
Yeah.
He probably doesn't deserve all the grilling, but he's responsible to some degree.
Well, go ahead.
We're showing a picture of the CEO of Boeing, Dave Calhoun, up there before that Senate hearing, taking questions from senators. Having said that, George, if you were sitting down with the CEO, like what would be top of mind for you? You understand this industry; it can be difficult. There's a lot of moving parts, no pun intended. But it's really important that they get it right and they get it safe. What would you want to ask Dave Calhoun and his team, for that matter? Yeah.
Yeah, look, I think from an investor standpoint, too, and my standpoint, one of the things I'd like to know, and a question that he didn't do a good job thoroughly answering was, these whistleblowers, right? So there's a lot of whistleblowers that are coming forward, and I think that concerns me, concerns investors, concerns everybody, that there's still potentially underlying problems at the company that haven't been addressed yet. And he mentioned he had an independent team that looks into every whistleblower, and I think we all realize that when you have a problem like this, there's a lot of people that may have grievances. Not all of them, might be worthy, but they come forward, right? And Calhoun essentially said that. He said, look, not all these whistleblowers have valid points, but it would have been interesting to hear some of the percentages there, like, what percentage of the whistleblowers that come forward, is he finding any there? And we didn't hear it. It's unnerving, right? Because again, we're looking for a turnaround.
Right.
And with all these whistleblowers coming forward, we're wondering, that's one of the near-term ways to figure out, is the turnaround occurring, right?
Yeah.
We don't know.
Well, Senator Blumenthal confronted Calhoun with what he called a broken safety culture, asked him to explain how Boeing allegedly retaliated against whistleblowers, but he was also asked if anyone had been fired for retaliating against whistleblowers. Calhoun said the company had done so, but could not specify how many. He said he hadn't spoken to any whistleblowers directly, though he acknowledged that while doing so would be a good idea.
Isn't that a problem that he hadn't spoken to any?
I mean, I think so. I think this is paramount, right? This is you need to be involved in operations every single day, and if anybody thinks there's anything going wrong with it, I think you want to be all over. I think that's one of the reasons Spirit Aerosystems slipped so far before they finally figured out it was a major problem, right? There was multiple problems coming through Spirit before the door came off, and then the door came off and everybody went, whoa, we got to get down there and figure out what's really going on.
Hey, George, you mentioned that senators are looking for a quick turnaround of this company, and that's not realistic with the way things are at Boeing and the way things have been. At Bloomberg Intelligence, what is your analysis for the outlook of a turnaround at the company? I know a lot hinges on the new CEO. We don't know who that is going to be at this point. But what's a realistic time frame that investors should have?
Well, I mean, to me, I think the big challenge here is that Boeing can't keep burning cash the way they are, and they can't produce at these low levels, this low throughput. And so we're actually expecting some degree of turnaround in the second half of this year, right? We saw May deliveries for the 737. They were really low. I think they were 19-ish. I'm speaking off the top of my head. But we really, in order just to keep the company alive, you need to start to see those numbers up in the high 30s in the back half of the year. So, we think they have to get to a non-cash burn stage or a minimal cash burn stage just to keep the company, in survival mode while they continue to refine their quality, performance and look at problems in the supply chain, figure out how to clear them up and get to higher rates.
How much more does the government need to get involved in this company?
I worry, right, when the government's coming to help you out in manufacturing, I don't think you're in a good place. So, look, I think the oversight is super important, and I think the FAA's there. I think it's more behind the scenes than what we're seeing this morning, but I think it's oversight. It's in the background. It's not in the forefront. I think it's really the board, the shareholders, management's job to really get this right now.
Well, it brings me to my question that I know you can't answer, George.
Nice setup.
I have to ask every time you come on. You're asked all the time, how's the search for the next CEO going, speaking of management?
Well, I think it took a leg down today.
Really? Why do you think that?
I mean, I think look at the publicity that the job has, right? If you don't get it right, again, look, the current CEO's had his challenges, and so he deserves to answer to Congress to some degree, but it's a very high-profile job with a lot of stress. As I left the hearings, Senator Hawley was asking him about his pay package and his increases, and so you live under a microscope.
You do, and we should note that Calhoun, although he was at Boeing when the 737 Maxes crashed in 2018, 2019, George, he was not CEO at the time.
Agreed. He was on the board, right? He was on the board, but he was not the CEO. But I think there's been other challenges since then that they should have seen coming sooner. But definitely on the crashes, that was an engineering problem, right? That was even more concerning when you're not engineering things correctly, designing them correctly. But again, manufacturing is super important to this business.
Yeah, and when
too.
you take the CEO job, right, you hope you kind of look at the house and like look at where the weak spots are and kind of try to figure it out and try to prevent any future problems.
It's a big business. I think as a CEO, you need a really good team of trustworthy people to be helping you manage that company. And something broke there hard. And I think we don't even know the full story yet. I'm sure there's more to come.
All right. Well, we'll be certainly following it along with you. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence. Boeing shares down about 33% so far in 2024. We understand why, and down about 2% today, Tim.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is the most read story on the Bloomberg terminal in the last 8 hours. It's about local groups in the South lamenting the migration boom of New Yorkers and Californians. Tennessee and several of its neighbors in the U.S. South are facing an anti-growth backlash after turbocharged migration helped boost the region's population by 2.7 million people. For context, that's about the size of Chicago.
It's a lot. And for a little context, folks are saying, I live in hell. We're going to get into that in just a moment. The story by Michael Sasso and Shelley Hagan. We're joined now by Bloomberg News editor Elizabeth Fournier, who edited the piece, as well as the journalist and author Henry Grabar. Henry is the author of the recent book, Paved Paradise, How Parking Explains the World. He joins us from Cambridge. There are shifts going around in the country, and this is where we want to go. Elizabeth, talk to us about what's going on in Tennessee in particular.
Yeah, so the reporter here, Mike Sasso, has been following this story, throughout the boom of this migration towards the south. He's based in Atlanta, and as we know, over the past sort of 2-3 years, we've seen this massive influx of people moving from the places you mentioned, from New York, from California.
Blue states, right? In
blue
big way.
states, traditionally blue states, also sort of Midwest, and heading down to Tennessee, to Texas, to Georgia, to North Carolina, for all the reasons that are obvious: lower taxes, lower house prices, remote work means they can be there. And for a while, it was this story of a boom. It was this story of huge growth across the South. It became this kind of economic powerhouse. And after the boom comes the inevitable backlash. And that's what Michael started picking up on. So he traveled to this town in Tennessee, Gallatin, in Sumner County, just outside of Nashville, and he went to planning board meetings, and he met members of the local council, who are made up of these commissioners who are sort of backed by this conservative group local in the area that sort of campaign on their behalves and got them into their positions. And these people are campaigning and now working to push back against this growth.
It's interesting. I'm reading this story, and I'm thinking to myself, the folks who are speaking right now, the quotes from the piece, it could be a planning meeting in just outside of San Francisco where they're looking to build affordable housing. Or look, in my own neighborhood in Brooklyn, where there are signs everywhere that are people pushing back against new housing coming to the area. There's not going to be enough parking spaces as a result of new development. I want to bring in Henry Grabar here. He's the author of Paved Paradise, How Parking Explains the World. Because, Henry, your book talks so much about communities using parking to avoid experiencing some of the development that we're talking about here. Is this the same fight that you're seeing spread nationally across the country right now?
Oh, I think it is. I think this story contradicts the assumption that many people have had, which is that conservative places will be more receptive to growth than their liberal counterparts because growth aligns with their general political beliefs, which is to say a more laissez-faire stance on regulation, a stronger belief in property rights, et cetera. And what this story shows is, in fact, everybody is concerned about traffic, about parking, about sewer capacity, about school capacity, and simply about change, right? It doesn't matter if you're a Republican or a Democrat or red or blue. When lots of stuff happens in your neighborhood, you're going to get upset. And I think what we've been realizing is that places like Charlotte and Nashville and Austin are just a few steps behind places like Los Angeles when it comes to rebelling against this type of growth.
You know, Elizabeth, I think about in an election year, right? Like how this all plays out politically and what candidates get backed, what candidates get momentum. How much of that is playing out politically?
Yeah, I mean, definitely. I mean, we talk about in the story, these particular county commissioners were elected in a very sort of off-season election, 15% turnout. That doesn't mean that they didn't have the support of people in their local community and that they don't now have the power to influence what that community is doing, what that community can build. Their concerns might be a little bit different than some of the people living in the bigger coastal cities. You know, they're worried about the loss of farmland. They're worried about the view out of their window that's been meadows for years and is now sort of development. But there are many commissioners, I think we talk about people in Georgia and counties across the south here who are running on this platform of, I won't let any apartments be built on my watch. I won't let any of the greedy developers come in and do this. And it seems to be a strong and successful platform for some of these people to be electioning.
At the same time, the Tennessee economy was the second fastest growing in the U.S. from 2020 to 2023, according to latest figures from the Bureau of Economic Analysis. I mean, Henry, right? You know, with migration, I have family who have moved from the East Coast, like New York Metro, down south, and their real estate that they bought is just booming. I mean, there's an upside economically, right? Businesses come in, there's jobs, there's creation, there's growth. You know, it's like everybody's got to kind of figure out the new mix, if you will, with these migration patterns.
That's absolutely right. I think there are a lot of politicians and business leaders across the Sun Belt who recognize that one of the big secrets to the region's success over the last 30 years has been low housing costs, especially in contrast to places like Massachusetts or California, where salaries might be higher, but all that income gets swallowed up in paying the rent or paying off the mortgage. So what's interesting about the situation there is that you're seeing these local groups start to try to establish growth controls like minimum lot sizes, apartment bans, and so on. But you have this counter trend, right, which is state level politicians in places like Montana and Florida trying to make sure that these local anti-growth groups can't get in the way of this dynamism that has propelled these states' economies up to this point. So it'll be interesting to see who prevails in that struggle.
So Harry, I'm wondering about the way that people should think about this in your view, because as Carol mentioned, economic growth is surging in places where a lot of new people came to live. At the same time, low housing costs attracted those people. What's the right balance here in your view? I mean, you wrote an entire book about parking and how parking explains a lot of the stuff we're talking about. What is the right way to look at this stuff? Because it's really nuanced. It's not that, you know, all development is bad, or that all these new folks coming into an area should be stopped.
The way I would think about it is this. When you have a society where every single person has to own and use a vehicle every day to get around, you're going to have inherent limits on the kind of density that is tolerable to people, right? And I think the obvious precursor to look at when you're thinking about these growth revolts in the Sun Belt is Los Angeles. For decades, Los Angeles was the promised land for many American migrants. You could go there. It was cheap to buy a home. You could have this beautiful view of the sea or the mountains or what have you. And Los Angeles has now had some of the most dramatic revolts against growth in the country in terms of downzoning, minimum lot sizes, rejecting apartments, all that kinds of stuff. And what that shows is that no matter the political persuasion of an area, ultimately, a lot of this comes down to traffic and parking. And when you put a certain amount of people in a neighborhood and they all drive, you are going to hit a limit where people don't want anymore.
Listen, I live in a neighborhood that's just across from Lower Manhattan. It's like the parking is becoming a nightmare. And we're like, stop the development. Having said that, it's about parking, it's about housing, but it's also about water. And you guys get in it. We've just got about a minute left here. Elizabeth, I want to bring you back because they talk about in some of the fast-growing suburbs of Texas's major cities, some communities are putting a halt on new construction because of water constraints. This is about having access to water.
It is. And, you know, these people aren't wholly anti-growth. You know, they have this moratorium on building, but they're also trying to come up with solutions. We have the city administrator talking about how they're going to build 2 wells a year for the next, they didn't even put a time limit on it. They just said for the foreseeable future, they're going to keep building wells in order to try and bring water to these areas. So there are parts of the country where people are coming up with solutions. The other idea is to levy these fees on developers. So you say, okay, you want to build 100 new apartments here, you build a well, you build a school, you provide money to the community. But those things tend to get blocked if the right people lobby against them.
Yeah, it's a tricky issue, but I have a feeling it's not going to end, especially as folks are aging, and moving, and we continue to see this migration to warmer places, lower taxes, all that good stuff.
You said it. You said it. Hey, a big thank you to Bloomberg News editor Elizabeth Fournier, who edited this piece. Again, the most read story on the Bloomberg terminal in the last 8 hours. Check it out. Also, a big thank you to author Henry Grabar, who's the author of the recent book, Paved Paradise, How Parking Explains the World. He joined us from Cambridge.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, almost 18 minutes left in today's trading session, getting ready, kind of ish, to wrap up the Tuesday trade. Kind of bouncing around. You heard Charlie walking you through the equity side of things. Kind of a mellow day on the equity side. Rates we've seen dip lower, unless you are Nvidia.
Let's see what Jay Jacobs has to say about all this. He's U.S. head of thematics and active equity ETFs at BlackRock. He joins us from New York City. Jay, good to have you on the program. Why even bother with thematics when we could have just gone back, 5 years and bought a bunch of shares of Nvidia?
If only it were so easy. I think looking forward, you have to see that this is the start of a major, powerful mega force. This is not just about one company. This is about the broader AI ecosystem that's rapidly developing around the world. I think some of the most compelling opportunities that we see today are really across the semiconductor space. This is not just looking at the GPU manufacturers. This is looking at CPUs. This is looking at high bandwidth memory chips. Really, you have to look across the semiconductor space to just see how important these inputs are into the growth of artificial intelligence today.
So would you be all in then, Jay, on everything and anything when it comes to semiconductors?
We're talking with clients every day about the semiconductor industry, and specifically we're seeing well over $1 billion come into our SOX ETF, SOXX, as people are looking to get that broad exposure to semis. And it's really about this story that this is going to broaden as you see more growth in AI. You're going to see more growth in data. You're going to see more demand for computing power. You're going to see more demand for data centers. You're going to see more demand for power. And so really it's looking across the AI value chain, specifically that infrastructure layer of chips, power, and data centers that's going to benefit over the next few years.
Can you say again how much money has been coming into this particular strategy?
Yeah, over $1 billion into our semiconductor ETF this year, and it's from investors who are really looking at broadening the play beyond just the mega caps and looking at the entire industry.
That's new money, so building on, or has there been any outflows considering the run up? I mean, we're up about 40% on the SOX this year.
Continuing to see inflows regularly in the product. Yep.
Jay, I'm curious about where exactly you're seeing flows in terms of the active equity ETFs that you manage at BlackRock. Like, where are you not seeing flows and where are you seeing flows?
Yeah, so, at a high level, we're seeing a tremendous trend in the ETF industry where investors are recognizing that ETFs are not synonymous with indexes anymore. ETFs are a tax-efficient, liquid, transparent vehicle that can be used for something as, straightforward as the S&P 500 or as nuanced as a highly concentrated basket of top picks in an unconstrained strategy like we have with our Belt ETF that we launched today. So, in terms of where the growth is coming from, a lot of this is coming from the ETF model space, where financial advisors are increasingly building models to put their clients into because it's repeatable and scalable. And those advisors want to have alpha in their asset allocation. So trying to decide, how much US exposure do I have? How much value exposure do I have? International, but also trying to generate alpha within those buckets. And that's where they're relying on active ETFs and active managers to generate those alpha within those buckets. That's what's driving a lot of the growth in the active ETF space today.
Okay, so let's talk about Belt. It's on the NASDAQ ticker BELT, the BlackRock long-term U.S. equity ETF, as you mentioned, launched today. The benchmark is the S&P 500. What does it offer investors that the S&P 500 does not offer them?
Well, about 80% of this portfolio is different from the S&P 500. It is an unconstrained strategy. It is not trying to have similar sector exposure or similar factor exposure to the S&P 500. our portfolio managers are looking at the 20 to 25 stocks that they believe are going to grow over the long term by compounding cash flows. And so that can cut across style and sector and really provide a differentiated source of alpha. Now, the way that we see clients using this is really barbelling their portfolios, getting that low cost, broad exposure through the S&P 500 through IDV, but then pairing that with a true alpha seeking, unconstrained strategy like Belt, where they can try to exceed the performance of U.S. large caps.
How likely, though, is it in that 80% of the fund, 20 companies, I believe you said, in the U.S., long-term growth, is it likely to mirror some of the most substantial names of the S&P 500 and some of the kind of big tech names that we constantly talk about?
You see a couple of the big names in there. And, look, a lot of these names are mega caps and have been as successful as they are because of their ability to develop powerful moats around their business and compound cash flow. So that's really aligned with the ethos of this product. But you also see some very different companies that are very distinct from the S&P 500. And that's why we have 80% active share in this product. It goes far beyond the Mag 7 and is really looking at, kind of unique drivers of return.
The 20%, the remaining 20%, I should say, my understanding is it can go into ADRs, American Depository Receipts, and GDRs, Global Depository Receipts. So we're looking at funds, companies outside the U.S. or companies outside the United States particularly. Is that a bet on those are areas of the global market that have lagged a little bit, or what's the thinking of that?
A lot of the, so you're right, international exposure is really only about 10% of this product today. It really is a U.S. focused product. But one of the areas where the U.S.
But it can do up to 20%, right?
Yes, it can. And one of the areas where the U.S. is not so much of a market leader globally is in the luxury space. So when you look at some of these long-term growth compounders, they're really luxury companies, primarily out of Europe, that have these tremendous moats around them and very strong business models. So that's where you get a little bit of complementary exposure that you wouldn't find in the S&P.
So like an LVMH or something like to that. I'm not saying that that's there, but those kind of companies.
Yeah.
Okay, let's talk a little bit about BRHY. This is BlackRock High Yield ETF. The benchmark is the Bloomberg US Corporate High Yield 2% Issuer Capped Index. Talk to us about the decision to launch BRHY.
This is really a story about providing choice of structure to investors. So we have the portfolio managers on this fund with the same investment objective and the same benchmark managing a BlackRock mutual fund today, the BlackRock High Yield Fund. And we've brought out a very substantially similar strategy into the ETF structure. The idea is that investors are increasingly looking at ETFs as their vehicle of choice. Again, this goes back to that model story. How do you build a scalable, repeatable outcome for your clients? And so we felt that having this strategy in both the mutual fund structure and the ETF structure is providing choice to investors.
Okay, so is this about where flows are going to be going, not toward mutual funds, but toward ETFs instead?
Part of it is we see the just tremendous growth in the active ETF space, absolutely. Part of it is also the relevancy of high yield bonds in models today. So if you look at people who are trying to grow their portfolio over time through total return or trying to draw high income from their portfolio, high yield bonds are a mature space with an increasingly important role in those portfolios. And so we see this as a way to get alpha within that bucket of high yield bonds.
All right, we're going to leave it on that note. Really interesting, and really appreciate your time. Jay, thank you so much. Jay Jacobs, U.S. Head of Thematics and Active Equity ETFs over at BlackRock, joining us on Zoom from New York City on this Tuesday. Interesting. I'm just looking at BELT, the BlackRock Long-Term Equity ETF. I think it looks like Microsoft Alphabet among some of the top holdings in that.
I've heard of those companies.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.